Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, February 28th, 2024. As always, we'll start with our executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is disconfirming evidence of our resilient U.S. economy and green shoots globally themes. The nuance there is that the dispersion in yesterday's conference board consumer confidence report did not support our resilient U.S. economy theme. While one economic release does not make a trend, poor dispersion in the European Commission's February survey data did not support our green shoots globally theme either. Elsewhere, the Bloomberg Energy Commodity Index is down 3% month over month, aided by a crash in nat gas. The combination of immaculate disinflation, sticky labor income, and depressed energy prices have contributed to better than expected outcomes for the U.S. consumer. In terms of market implications, dips continue to be shallow in U.S. stocks as ample liquidity closes the gap between buyers and sellers. Refer to yesterday's leadoff morning note and Saturday's Around the Horn for our updated outlooks on U.S. and global liquidity. We've heard a lot of misguided analysis over the past year plus about how both excess savings and low-income consumers were quote unquote tapped out. The only thing that bear porn got investors in return is a lack of participation in a raging bull market. Upside capture for the average investor, be it sell side, buy side, RIA, and retail included, may have never been as low as it has been over the previous year, which suggests the current Goldilocks bull market is likely to persist as investors are forced to continue playing catch up. Transitioning to our 42 macro dashboard here. As always, we start with trading range signals from our friends at Longbow, getting the same signal in Bitcoin as we got yesterday in terms of being wickedly overbought. That doesn't matter right now in terms of price momentum. This market looks like it wants to go straight up to to eclipse its all-time high. So I wouldn't be fighting that at all. Certainly not with the bullish BAMS signal there. In terms of what else we got here, getting a near overbought signal here in Ethereum as well. But again, these things are in raging bull market. So, you should know by now, one, I don't think any retail investor in the world should be shorting. But if you are going to insist on playing Captain Hedge Fund, if you're a retail investor, definitely don't short raging bull markets. Don't short bullish VAMs, bullish instruments that are bullish from the perspective of our volatility, just a momentum signal. That's a no-no. If anything, if you're using tactical trading signals, what you want to be using these tactical trading signals for is if you have a dynamic position sizing process, you can be trimming some and thinking about buying, giving yourself a better opportunity to buy dips. Or if you're using it, or if you're dollar cost averaging in an asset like Ethereum or Bitcoin, you can use the trading ranges to speed up or slow down your dollar cost averaging process. So as you approach the lower boundary of a trading range, you can buy faster, you can accumulate faster. If you approach the upper boundary of trading range, maybe you slow down your dollar cost averaging to account for the fact that there's an elevated probability of short-term market risk. So that's how you think about using this. Again, not everything's always overbought, therefore you must short. If anything, 9 times out of 10 things are overbought. Just telling you that it's not necessarily the best time to be plowing incremental assets in. So transitioning to 42 macro community, wrapping up with the question from our community. This one really isn't a question, but I thought it was important to unpack this discussion, which is the question reads, the statement reads, I'm beginning to see Bitcoin being added to balanced all-in-one ETFs. One major institution offers 4 different all-in-one ETFs, and Bitcoin is in every fund as of this month. That's good news for KISS, as institutional demand will be a growth driver. All the best. So just want to say thanks for that. Certainly good news for KISS, because I can tell you right now that those balanced all-in-one ETFs that feature Bitcoin do not have our top-down risk management overlay and bottom-up risk management overlay that are the key features of our KISS portfolio construction process, our flagship KISS portfolio construction process that thousands of you around the world are following, and we appreciate that. So, so just a quick, some summary statistics for KISS. You've heard me say this many times in different broadcasts, but KISS, the average annual return there is 13%, with a max drawdown of minus 11% over the life of the out-of-sample back test, which begins at the beginning of 2018. If you compare KISS to 60/40, which is benchmarked against the 60/40, the average annual return is 8%, with the max drawdown of minus 22%. And there are 2 crashes, i.e. drawdown in your portfolio of 20%. 2 of those have occurred in the 60/40 portfolio since January 2018. If you wanted to run a version of KISS that did not include our top down and bottom up risk management overlays, which are guided by our macro weather model and volatility adjusted momentum signal, respectively, you're going to be subjecting yourself to a tremendous amount of downside capture when the tide does turn in the crypto market, because Bitcoin becomes a very dominant driver of returns if when you add it to a traditional balanced portfolio, if you're not appropriately risk managing the position size. And so if you ran a 60% SPY, 30% ag, and 10% Bitcoin without our top down and bottom up risk management overlays, the max drawdown, the average annual return is about the same as it is in KISS, 14% versus 13% for KISS. But the max drawdown for running 60, 30, 10 Bitcoin, SPY, AG, Bitcoin without our overlays is minus 26%. And moreover, you've crashed 3 times since January 2018 in that other sample back test, just being, naked long 60% SPY, 30% AG, and 10% Bitcoin. So again, you're going to see a lot more proliferation of Bitcoin being added into TradFi multi-asset portfolios. I think we are the global intellectual leader in how to actually do that from a systematic and also from a systematic standpoint, and also actually doing it in a way that helps investors maximize that upside capture, book those gains, and minimize downside capture relative to what you're about to see when we inflect into the next crypto winter from a lot of these new ETFs that offer Bitcoin. People are going to have a very, very negative experience investing in this asset class if they do not have some way to get out at or near the highs, and we pride ourselves on having those tools and those instruments. So we'll wrap it up there. Darius Dale here presenting our macro minute for Wednesday, February 28th, 2024. If you want to check out KISS, definitely come check us out. Hit us up on Twitter or on LinkedIn if you want to check out our sample research, and I'll tweet out today our KISS back test summary so you guys can take a look at that on your own time. So we'll catch you back here tomorrow. Everyone have a great day. Cheers.